For the better part of a year, it felt like the market was singing one song, led by one very, very loud instrument, US tech. But lately, the orchestra has started playing out of tune. Something big is changing deep beneath the surface. So let's dive in and figure out what is really going on. And this is the big question on everyone's mind, right? Are we seeing the end of the good times, or is the party just moving to a different room? Well, the data is strongly suggesting it's the latter. A massive rotation is underway, and it's creating a completely new playbook for investors.
To really get a handle on where we're going, we've got to first remember where we've just been. The narrative was simple, it was powerful, and everybody knew it by heart. The AI boom was lifting a handful of tech giants, and they were pulling everything else up right along with them.
And that story, wow, it had the numbers to back it up. The Nasdaq 100, which is basically the poster child for this whole AI rally, was up nearly 16% over the last year. That wasn't just a number. That was the engine of the entire global market, the undisputed leader setting the pace for everyone else. You see, this wasn't just some passing trend. It pretty much became an article of faith. A single, unified market story where what was good for big tech was good for the world. But that single story, well, it's starting to fall apart. Which brings us to today, our new reality. We're now seeing what you can only call the great market decoupling. That single engine has kind of stalled out, and other long-dormant engines all around the world are absolutely roaring to life. The unified story has fractured into a bunch of different regional tales. Okay, now check this out, because this is where the reversal becomes so clear. In just the last month, the Nasdaq 100 has dropped nearly 3%, while at the same time, Europe's top 50 stocks have gained. The leader is stumbling, and other developed markets are stepping up to take its place. And this is not just some short-term blip. If you zoom out to a one-year view, the story gets even more dramatic. While the S&P 500 posted a solid 15% gain, emerging markets, and this is key when you exclude China, have rocketed up an incredible 40%. The numbers themselves show a massive long-term transfer of momentum. So how unusual are these moves really? This chart of Z-scores helps us see that. A Z-score just measures how far something is from its average. A score of 2 or 3 is a huge statistical outlier, an event so rare it happens less than 3% of the time. Now just look at this table. You don't have to read every line, just notice that bright green next to gold with a Z-score over 3 and the deep red next to Bitcoin with a score of -2. These aren't just small shifts. These are statistical earthquakes happening at the exact same time. Let's zoom in on the most extreme examples of this split because it isn't just happening in stocks. We're seeing a massive divergence between traditional safe havens and modern speculative assets, and it tells a really clear story about fear and greed in the market right now. Look at this number. Just look at it. This is gold's one-year Z-score, a move of more than 3 standard deviations from its average. That's a statistical earthquake. It signals a massive, undeniable flight to the safety of hard assets, a classic move investors make when they get really nervous. And at the exact same time, look what's happening at the other end of the risk spectrum. This is Bitcoin's one-week Z-score, a 2 standard deviation plunge. So while capital is rushing into the perceived safety of gold, it's simultaneously fleeing the speculative world of crypto. And we're not just talking about paper losses here. We're talking about a 25% drop in just 1 month. Billions of real dollars have been pulled from Bitcoin ETFs, contributing to what is now a full-blown crypto winter. It shows a profound shift in risk appetite. So we've got individual assets going in wildly different directions. But what's even more significant is that the fundamental relationships between asset classes are also changing. The basic rules of the game are literally being rewritten. The entire system is rewiring itself in real time. Take the stock-bond correlation. Think of it like a dance partner. For years, stocks and bonds were basically moving together. But now that relationship has violently snapped back. The correlation is strongly negative, which means when stocks fall, bonds are rising again. Bonds are once again acting as a safe harbor, and that is a huge regime shift for how portfolios are built. Now here's an even stranger one. Normally, corporate credit and stocks move together. They're both basically bets on a company's health. But recently, they've moved in totally opposite directions. Equity investors who bet on a company's growth are getting nervous. But credit investors, who are just betting the company won't go broke, they seem to be ignoring the warning signs. This signals a major gap in how different parts of the market are seeing risk. Okay, so what does all of this add up to? We have diverging assets, broken correlations, and a fractured narrative. Let's put these pieces together and actually define this new market regime we find ourselves in.
This number here represents our current reading on a systemic turbulence index. It's in the 75th percentile, which means market stress is higher than it's been 75% of the time historically. Now, what's important to understand is this. It's not a five-alarm fire. It's not a crisis, but it is a very clear yellow flag telling us that conditions are choppy, they're unstable, and they're well above average in terms of stress. So here's the bottom line. The simple, easy-to-follow story of AI lifts all boats is over. We've entered a much more complex and fragmented world. There are clear winners, like gold and emerging markets, and there are clear losers, like US tech and crypto. The single tide that lifted everything has receded, revealing a dozen different currents all moving in different directions.
And that leaves us with this final critical question. For the past year, everybody looked to a handful of US tech stocks for direction. Now that they're no longer leading the way, the market is searching for a new guide. And in a world this fragmented, finding that direction is the biggest challenge of all.